Hey guys, I'm going to walk you through the 3-5 hedge or the Sweet Bobby hedge, and this would have saved you in the Monday market crash. Now the thing is, we all hate losing money. I know, because I personally lost $20,000 on this market crash. And so again, I want to show you a hedge that would have covered most of your losses and covered most of the risk that you had on in the account, and exactly how you can structure this, whether you have a large or small account. So again, it's called the 3-5 trade, and why is this? Well, most of the problems that people ran into with 112's 111 short strategies in this market with this crash and volatility expansion is what's called Vega risk. All their positions were in shorts. And so when the volatility increased, they had nothing that would increase in price with it to offset those values. And so with that, the best way to do that is to have long options to offset the volatility risk, which is kind of known as Vega. And so what we do here is we need to put on some long puts. But how do we put on long puts in a way where we can do so in a cost-effective manner that also gives us good protection? And that is what a 3-5 trade is. So let me walk you through exactly how a 3-5 trade works. Again, I'm going to do it on ES, and then I'll show you how to replicate this on MES and SPY if you have smaller accounts. All right, again, MES will actually be for the smallest accounts. So first, let's go to the table here. This is what a 3-5 structure is. A 3-5 structure gives you 5 long puts, and then you use 3 short puts to offset the cost, which gives you net 2 long puts, so that when volatility increases, you have 2 long puts that will skyrocket and help cover cost. And so let's dive in and look at this. You can do this on a monthly basis, and if you do it every month, you can enter around a 30 DTE or maybe even 33 or 35, so that it overlaps a bit with each time. But again, this will be like a monthly tranche that you kind of put on. So let's go in just to this 34 era just to kind of give an example here. So what we'll be doing here, we'll go out to about the 30 delta point, and what we're going to do is we're going to come in here and we're going to, let's go, again, I'll show you how we can play around with these numbers, but for now we'll start here. So what I'm going to do is I'm going to buy around 28 delta. This is just numbers for now. I'm going to buy 5, and I'm going to sell 3. So this leaves me with net 2 long puts. And again, I want long puts in order to help with the Vega risk, with the volatility expansion risk. Okay, let's look at the analysis page on the curve. Let me remove my other positions here for now and show you how this is structured. So this is what it looks like. I have the 5 puts that will dramatically go up in value if the market drops and if volatility increases. But I have these 3 short puts that will help kind of offset my cost, because it would cost me a lot more just to go out and buy 5 puts. But now I kind of get the profit of them without having to bear the whole cost. And so you can see here, this is still a very expensive trade right here. It's going to cost me $5,500. And so if you want this to, but at the same time, it's going to give you a lot of protection. Look, if the market drops 600 points like it did earlier this week/month, if it would drop 500 points, we'd be up $30,000 from this hedge. And that's about the same even if volatility expands, right? Just to show you what that looks like here. If volatility were to expand let's see, what 2 positions am I looking at? The September 11th. Let's look at these 2. If volatility were to go up by 25%, or let's just go 30% each, what would this new profit graph look like? Just like this. Look at that. The profit got even higher. Even if the stock stays where it is, but volatility goes up, I'm now making $20,000 to $21,000 on this trade. And so that's why this hedge could have saved you so much money when we experienced that on Monday, because volatility skyrocketed, which means our 112s went dramatically up in value, which is not good. And if we had this hedge, we could have offset a lot of those losses to allow us to stay in these trades longer. So if you're still going for the 112 trade, which is a very profitable, very amazing trade, put on a hedge like this that will increase in value when volatility goes up as well. So let's reset this and let me show you how to actually make this cost cheaper depending on what you want to do. So again, if we push these 2 puts out, and again, we put this up with it, this will make it cheaper because, we're going further away. You can see here, also the closer we put together these 2 options together, which means the less of the spread we have, the cheaper it gets. So again, by pushing this out and making the spread smaller here, we already went from $5,500 to $2,800. So still, you have to consider here that this, you can see the orange line, it's still giving you amazing protection as the market drops, and the volatility increase is going to make you even more. So again, if you're actively trading 112s on ES, again, in a month, you'll make anywhere from, I mean, depending on how much you're trading, but you can make from $4,000 to $8,000 to $10,000, somewhere in there, and then now you can put on one of these. So again, you'll be giving up about 20% of your profits, but now you have a solid hedge. Now, for those of you like, okay, this is too expensive, how do I do this? Well, that's why we always have the alternative, which is MES. So again, even if you're trading ES 112s, but you don't want to pay that much money, you can, for the hedge, you can go to MES, and you can even do this hedge more often because it's cheaper. But let's structure this roughly the same way. Okay, so let's go here to the trade table. We're going to go to roughly a 42-day out. That's a little past 30, so we can do this on a monthly basis. Again, yeah, so we can just set this up on a monthly basis. Let's go out here to roughly the 30 delta point. I'm going to buy, let's just set this up here and sell. So I'm going to click on the buy here. We're going to buy 5, and then we're going to sell 3 to help offset losses, but still give us a lot of money. All right, so if we go to the analysis page, we go to the curve. All right, we can see here that now we're paying $600 for this trade. It costs $600 to put this trade on, about $700 actually, to put this trade on and buying power. But you can see like this, we're still making a lot of money. So again, if the market were to drop and go down 600 points like we did from this month, then we're looking at about a $2,000 profit, which again is decent, but it's only going to cover maybe one of our 112s. So we might have to move this closer so we generate more of a profit. It's going to cost more. You can see here, this is going to cost about $800, but it's going to give us some good protection to the downside, about $3,600. So this is one that you can put on a monthly basis, because not only do we get that downside protection, but it's a Vega risk hedge as well, because we have the long put. So if volatility were to increase by 30%, then we would also be looking at a great profit as well. Let's double check this here. So if volatility were to increase and the market were to stay the same, well, we're already making $2,000. And if the volatility increased and dropped about 300, 400 points, which is what happened, we'd be down around here, and we would have a profit and loss of $4,000. So that would still help offset our losses a lot. And so I highly encourage you to check out this 3-5 strategy, or simply just buying puts, because that's going to be a volatility risk hedge and also hedge your account in the process. And so this will allow you to stay in 112 longers, to see the volatility decrease and your positions to stabilize. Anyways, I hope this made sense. I hope you enjoyed this video. If you want to learn more, please smash that subscribe button, and I'll see you in the next video. Bye, guys.